That outlook might sound draconian, but here at the Milken Institute Global Conference in Los Angeles, the world's top investors are asking how much longer the good times can last. The current bull market rally began in 2009, making it one of the longest on record. The tax cuts President Trump signed in 2017 could juice markets a bit longer. But some investors gathered at the Milken Conference also feel forces are now swirling that will trigger the next downturn. The most direct cause of the recession that began in 2007, and the financial crash of 2008, was excessive consumer debt, mostly in the housing sector. Next time, it will be different, Maynard says. In this downturn, it's the corporate sector, Maynard says. Corporate debt to GDP is at record levels. And when you look at what CEOs are saying, they're going to use the benefits of the tax cut to repurchase stock, to engage in M&A activity. No one's really talking about reducing indebtedness. The tax cuts, meanwhile, will add to U.S. government debt. And while the Federal Reserve is gradually raising interest rates, they may still not be high enough to allow for aggressive monetary policy by the time a recession hits and the Fed needs to cut interest rates. We're in danger of having a collision between monetary policy and fiscal policy, Maynard says. If Maynard is right, some of the riskiest investments include high-yield bonds, other fixed-income securities, and eventually stocks. But some investors will undoubtedly hold on, hoping to squeeze out the last gains before the market turns. Keep a parachute handy. Confidential tip line, Rick Newman at News Pulse. Click here to get Rick's stories by email. Rick Newman is the author of 4 books, including Rebounders, How Winners Pivot from Setback to Success. Follow him on Twitter, at Rick Newman. Follow News Pulse Finance on Facebook, Twitter, Instagram, and LinkedIn.